Hello and welcome to the Unique CPA with your host, Randy Crabtree. The goal of our show is to keep you at the forefront of the changing face of public accounting by having conversations with fascinating leaders and bringing you their stories, insights, and advice. The Unique CPA podcast is brought to you by Trimerit, the specialty tax professionals.
Today, our guest is Dan Hood. I probably don't need to introduce Dan, but I'm going to. So Dan is the editor-in-chief of Accounting Today. He's been in that role since 2011. He joined Accounting Today as the managing editor in 1998. So he's been the voice of our profession for quite a long time now. He hosts the Accounting Today podcast, which I was very fortunate and honored to be a guest on recently. Dan, welcome to the Unique CPA.
Thank you for having me. I'm excited. This is great. Going back and forth between the podcasts, we could just be each other's guests for years and years. We never need to talk to anybody else.
All right, done deal. I'm signing the contract. Here we go. But like I said, I really was honored for me to be on that. You and I recorded last week. It'll be coming out, I think, shortly before this comes out, I would assume, or about the same time, probably.
Yep.
But like I said, I really do feel that you've been the voice of our profession for a long time. I've been in this profession a long time, and I predate you, but I remember at least Accounting Today going way back with me in the profession.
Well, I would say maybe Accounting Today might have been the voice of the profession. If I'm the voice of the profession has bigger problems than I think it does. But no, it is a fascinating profession. There's a lot going on. It's an exciting area to cover. I should say, this is one thing I never talk enough about, but I'm not an accountant. I have no background in accounting. I'm a background in journalism, and came into it to cover the space. And it is genuinely fascinating. And it's been the last 25 years. You remind me, have been exciting and fun. And it's a neat profession with a lot of exciting aspects to it, and covering it has been great.
Yeah, and there's a lot of change, accelerated change, probably recently as well, but it's probably always been change. But there's a few topics we'll probably talk about today regarding that, what's going on in the profession. But before, I really want to talk about this for a few minutes, or as long as you want. You do have a conference coming up in May. I think is the May 8th. Is that the day?
Yep, May 8th to 10th in San Diego.
And so give us the theme of this and
Sure.
and how this came about to do this.
Absolutely. It's called the Firm Growth Forum. And one of the things we're thinking about is that, accounting firms are so busy helping their clients grow and helping their clients succeed in their businesses. That's sort of, it's a shoemaker's children kind of a thing. They often don't have time to focus on their own growth. And with, as you mentioned, there's so much change going on. And I think there's more change going on now than at any point in the 25 years I've been paying attention to accounting. And it's difficult to keep up with it. It's difficult to keep up with all the different changes internally, externally, with clients, with staff, with the structure of the firm, with all the different technologies that are coming out. There's so many options. Listen, forget about the challenges. There's just a ton of options to pay attention to. And so one of the focuses of this event is to bring accountants together, particularly leaders of accounting firms together, to figure out how to make their firms better. So we're focusing on the structure of the firm, the services firms are offering, how they're handling staff, right? The war for talent is an enormous issue. How they're figuring out succession planning, what they're going to do about PE, private equity coming into space. That's a big topic, right? These days, new service offerings around ESG, CAS, cannabis, cybersecurity, all the different new service offerings that firms are paying attention to. That's our focus, is that sort of aspect of the sort of working on your business as opposed to working in your business. And we're excited we're bringing you're joining us. We're bringing a lot of experts from all around the space to talk about what it means to run a modern firm and what it takes to be successful at that. We're psyched about it. We think it's going to be very exciting. We haven't done a conference in a decade or so. We've been in the space for a bit. There are a lot of shows out there. We think this one's different because of that, specifically that focus. There won't be a lot of technical education. There won't be a lot of tax law or standards or that sort of thing. It's really more about working on your business than working in your business.
And which I think is hugely important. That topic comes up a lot, at least with me personally, because I think a lot of times, and you mentioned it, I say CPAs generically, EAs, CPAs, tax preparers, bookkeepers, accountants are so focused on helping the client, is what you said, helping the client, being the resource for the client, coming up with the solutions for the client, helping them grow, that they forget that they have a business that needs all the same things. And often I've heard people like, oh, yeah, I do own a business, don't I?
I'm a small business owner, too. Hey, wait a minute.
Yeah. And I think that's important, especially when, like you and I talked last week about mental health and just, not putting your nose to the grindstone and working 80 hours a week. I think working on your business, I think, is important. So I'm really looking forward to this, and thank you for choosing me to be one of the presenters. I'm really looking forward to that.
We're excited about it.
All right. All right. So then you just said a bunch of things that we could expand on.
Well, I got to save some of it for the show, but for the event. But
no, we're going to record for 24 hours straight right now. We're starting a marathon.
Right. This is going to run through May 8th, and then you can join us live.
So one of the things that I was really intrigued by, and it's going to be addressed somewhat at the conference, it sounds like too, but I was intrigued. You put this question out, I think it was last August, and I'm probably going to get it wrong. You can correct me, but what I think it was, do we still need accounting firms?
Yeah.
And I was like, when I saw that, like, wow, that is awesome. Everybody's going to answer this. There's great information that'd be out there. And you wrote this up in an article, in August, and then the responses in October. But let's talk about that. Do we need accounting firms, or is it just more of we just need to change the way accounting firms are structured? What was the whole point of the question?
Right. Well, it's worth before people mobs with pitchforks show up outside my door. It's worth explaining. The framing of the question is: is it the structure of accounting firms? Do we need? Well, obviously, everybody knows we need accountants. Everybody knows we need accounting services, both on a compliance and an advisory folks. Either way, we need those. Everybody needs those. There's never been more demand for accounting services. So that's not really the question. The question is, do those services need to be delivered in the traditional accounting firm structure, right? Where lots and lots of raw talent comes out of schools, goes into public accounting firms, gets winnowed down to a sort of pyramid of partners. The traditional, some people call it the pyramid shape. Do we need that? Is that functioning properly? Is it doing the things we need? And is it sustainable? So that was really the question was, are there other ways to deliver these services? Are there other ways that accountants might be happier to operate? Would they be less stressed or less, or feel freer, be able to offer the services the way they want to offer them in a way that's maybe better for their clients? Are there ways that are more capital efficient, or that better meet the demands for capital that the modern accounting firm is running up against? Obviously, there's all kinds of talent issues that goes into this. We don't have the mass number of young accountants coming into the profession that we used to have, which supported that model of, right? You had, like I said, that pyramid, that broad base of thousands and thousands and thousands of fresh out of college students coming into the profession. I don't want to say getting chewed up, but being put to a ton of grunt work, and then getting sort of winnowed down to a small group of partners. They hive off. Someone would go off into industry. Someone would go off to entirely other professions. Someone would go off to nonprofits, et cetera, or start their own small firms. But really ended up with this small number of partners. So that was the question: are there other ways to organize the delivery of accounting services in ways that don't require the firm? Because there are many problems with the firm, and the responses were a mix of personal threats. No, there were no personal threats, but I mean, there were some people who were very upset about it, who were like, of course we do. Some of it was conflating. Like I said, I wasn't saying we don't need accountants.
Right.
I was saying, do they need to be organized in firms was really the question. But then there was a lot of thoughtful responses on all sorts. Some disagreed with me, but were thoughtful about it. And some people were whole hog on it and wanted to try things that I wasn't even prepared to imagine. And so it was neat. It was fun. It's fun to throw a question like that because accountants think very deeply about their profession and think about what they're doing and get very passionate about it. So like I said, death threats aside, it was a great experiment. And I think there was no consensus. That's, you wouldn't expect there to be, but there was certainly a recognition that there are problems with the model. Some people said it's the worst possible model except for all the others. And some people were like, no, it's perfect. And some people said, yeah, we're going to have to do something about the talent issues and the paying out retirements to, a large overhang of partners when there aren't enough partners coming up. And there's so many possible answers to and different possible structures. Sort of my take. And I don't know, I'm sure you have thoughts on this and I'd like to hear them, but my sort of take is we're probably going to have all these models. Yep. Some firms will keep the old firm model. Some firms will try whole new collective hive mind things that we've never imagined, and others will try entirely. Others will be competitors coming in from outside the space. But anyways, what are you were thinking about this? We've been talking about it, but
yeah. So I'm the same. I'm the same way as you. So what I've seen is traditionally I don't know what the right term is, audience or my interaction with firms for up until the last 3 years has been top 400 CPA firms. And that structure has been in place for most of those for a long time. There's some, call them modern firms that haven't been around 50 years, just me in that may be doing things a little different in that top 400, but traditionally they've been around a long time. They're under the structure, and I don't see it changing that much, although with private equity, they're restructuring and there's obviously going to be change, and we could probably talk about that. But what I've seen is the modern, what I used to call it, millennial firm, whatever, startup firm, 30, 40-year-olds starting up their firm. They've been around 10 years or something. I've seen a completely different mindset on structure there. And I honestly like it. There's not one set stone, this is what we're going to do, but there is from Josh Lance, who started a firm in Chicago, who was remote from day one, doesn't have the partnership structure, but he allows employees that meet certain requirements, so many years there, to buy into the firm as well. So they can be a partner. It's not just you're named a partner. You choose if you want to come in or not as an ownership structure. You have firms where the owners are out doing modern firms, again, out doing a lot of things like you and I do, out promoting the profession, out talking on podcasts, out at webinars, at conferences talking. And they've built their firm which I think is extremely important. And I'm supposed to be interviewing you, but we're going to keep going with this for a second. So I like the back and forth. This is awesome.
Yeah. No,
so they've done these things like where they've created a sustainable firm in a short amount of time where this firm can run without them. And so I think that really should be the goal, that the firm can run without the person that started it. And they're still the figurehead, but they're out doing all these other things, which I find so cool and interesting. There's firms like Acuity that I didn't even know existed. They're 150, $12, $15 million firm that I didn't even know existed until a year or two ago. And they built their firm based on pretty much what they've seen in tech startups. Yeah. They take that same mindset and they've put it into the firm. So I think there's a lot of opportunity for change. I think change is probably needed, and especially when you said it, when we talk about the employee attraction and retention. Apparently, there's something out there that people don't like, and if we could do things better, hopefully that helps with that.
Yep. No question. I mean, there's so many options. Right? I mean, you talked about alternative ways to become a partner. There has always been one or two firms that were ESOPs for the last 25 years, but I keep hearing a lot more talk about ESOPs. And at Graves, it's not quite a partnership. It's not really the same thing as a partnership, but it does give everybody a stake, or almost everybody who wants to have a stake in a firm. That's a new model, right? And that's in many ways possibly a longer lived model than the current accounting firm model. Are there ways we could change the current firm model to allow that to have a long lifespan? Sure, private equity is helping with that, right? It's pulling forward some of the partner reward to a more, to a younger level. Let's put it that way. So yeah, it's going to be interesting, and I think the most interesting thing about it, as I said, is that there's going to be a lot of different kinds. There's going to be, with the rise of gig work and that kind of that economy, I think we're going to see a lot more firms. Firms that aren't firms. We're going to see a lot more firms that are sort of collectives that come together to do individual projects. And okay, I got my tax guy, and I got my my accounting guy, and I got, or maybe the tax and accounting guy work together all the time, but then they bring in their payroll guy for somebody if they've got a CAS practice, or they bring in their, not like kind exchange, what's the one I'm thinking of, the cost segregation study guy, or whatever the case may be. We already have models for that, right, of partnering between firms for specific engagements, and I think we're going to see a lot more of that. I think we're going to see firms get smaller, but with longer reach, because they work with a lot of other people.
Yeah, I agree with that. And I think becoming that niche. So smaller firm, but you have a niche. And again, I mentioned Josh Lance. Josh Lance's niche is the craft brewing industry. He is known as that. And so he has this niche, but then there's things within that niche, like you said, cost seg or R&D or just payroll in general, I don't know if they do it this way. I think they do, but then they team up with someone else to bring in the experts. So you could still be that point of contact for your clients as the expert, but man, you just can't know everything in this profession. It's impossible. And so I think that's a model I think we will see more. And that's kind of what Tri-Merit's done for the last 16 years. We've been an outsourced partner for tax preparers on specialty tax. And I think I can see that accelerating. So let's talk about that, though, in general a little bit. There's a couple things that came off of that in my mind. We talked about employee retention. Is there a model that we think is going to be better, or remote work? Is that somehow going to change the business model as well? Any thoughts on how we get people into the profession?
If I had thoughts, I would be the voice. Then they would crown me king if I could solve that problem. But
Yes.
yeah, I think there's a lot of things that the profession can do and has been doing to give full credit. I mean, the profession hasn't been standing still. Where I think we may be making it seem like they're mired in the past. They're not. They've been making lots of changes. We
Yes.
follow. I give you an example, and I love this because we've been doing our best firms to work for list for I think it's now in its 16th year. This will be its 16th year, I think. And when we first started it, the difference between the number 1 firm and the number 100 firm was enormous. It was actually 1 to 60, but that doesn't matter. The point is, between the top firm and the bottom firm was enormous. The bottom firm was, it was fine. It was acceptable. We didn't put any firms on the list that weren't good, but it
Right.
was nowhere near the number 1 firm. The gap between them is enormous. That gap has narrowed entirely. The difference between the number 1 firm and the number 100 firm, it's actually, we do it by size, so it's a little less than that. But I mean, basically, the top firm and the bottom firms in that list, or the worst of the best, is tiny. It's, I think of it as Olympic timing, right? Where it's like a tenth of a second is what separates the number 1 from the number 2. They're all really performing well on all the things that it takes to retain talent. They're giving flexibility and mentorship and development and compensation and benefits and bonuses and opportunities to be a leader at a younger age, all the different things that firms need to do. So we're seeing that, they're doing the best they can to make themselves attractive. I don't think the burden really has to be on the firms per se. It's the profession as a whole needs to figure out, what are the causes? Why aren't people coming in? And there'll be a lot of argument about the 150-hour rule, if that's the thing. I think that's a part of it, but there are a lot of other parts to it too, which is, one, it is very difficult to compete with technology and finance, both of which took off exponentially during the 90s. And that's when this shift really took place. The decline of accounting students went from, sort of 2% of all students were taking an accounting degree down to 1%. It got cut in half.
Wow.
And that took place in the 90s. And it's not, 150-hour rules, you say, maybe keeping people away. But I think it's that suddenly you had technology saying, hey, we like people who think well in systems. We like people who are good with numbers. We like people who are comfortable with taking a framework and applying it to other things. A lot of the analytical skills that go into making a great CPA or a great accountant or a great EA or a great anybody in this profession are talents that are equally exciting to technology, which pays a lot more. And it's similarly for finance. People don't talk this about as much, but the finance industry exploded over the course of the 90s. It started in the 80s, but exploded really over the course of the 90s, became huge and started paying enormous sums of money. And again, was a little sexier and sounded, I work for a commercial bank or an investment bank. Sounds a little sexier than I work for a CPA firm. And they're paying a ton more money. So I think, those are all the broad structural issues of the workforce and of the competition for accounting firms that maybe the profession needs to deal with. Because as I say, I think firms in general are doing their part, or at least they're working very hard. One area I will say, though, you mentioned remote work. I think remote work is one area where the profession probably could do a little bit more work on. We do some surveys. The company that owns us owns 6 or 7 other B2B publications, and we'll occasionally do surveys across all of them on broad topics. Remote work was one of them, and how you're going to handle sort of the return to work post. No one can see me. I'm making air quotes around return to work. We did a survey as to how they were going to handle that. At the end of the pandemic, how do you expect your people to come back to work? And accounting was a far outlier in terms of expecting people to come back to work much sooner and much more completely than any other industry. I mean, like 10 to 12 percentage points out from the others. So, all the banking industry and the insurance industry and the financial planning industry and the bond market and the bond industry and 2 or 3 others that we cover, we're all saying, well, yeah, we want people to come back in the office, but we're not going to expect them. And accountants were like, nope, get back in the office now. And obviously there are plenty of firms that are not being that way. They're embracing remote work. But overall, our respondents were way out of line with the sort of general workforce and the general market. And at the same time, complaining about not being able to find staff. It's like, well, maybe if you listen to them when they say, I don't want to come back to the office, or I only want to come back to the office 2-3 days a week or something like that. That's one area. In general, as I said, I think firms are doing well in terms of addressing the desires and needs of potential staff, except in that one area.
Yeah, and I think that's a big deal because I've seen that again, going with my definition, legacy firm and modern firm, I see a big disconnect there on the remote work. This is just me anecdotally. I don't have numbers or anything, but that's what I've seen. And I think that modern firm is not having the same problem getting employees as that legacy firm, especially a legacy firm that is going to say, yes, you need to be back in the office. So that's just something we need to address. A couple things then based on that. Again, you get me so excited. Some things that you said here that these, I don't know if they use the term sexier looking industries, but the banking and the finance and I don't know if insurance is the sexy looking industry, but we'll keep them off. But technology firm, they're paying more. We have students that have to go an extra year and we're not paying them as much as somebody that's maybe not even getting a college degree. And if they are, they're going only 4 years. Right. It sounds like we have a pricing problem as much as anything. I don't know if you have any thoughts on that.
Yeah, I mean, and this was, we every time we talk, I have a different study to cite because we do a lot of research reports. But we do our top 100 firm list, and last year, effectively every firm on the top 100 list said at some point we reviewed our compensation this year and gave raises. And many of them said we reviewed our compensation twice and gave raises because this was the middle of the Great Resignation and everyone was concerned. And it's like, if you have to look across your workforce and review your compensation twice in a year, that's got to tell you something's wrong with your compensation to start with. Right. And it's not like accountants are poor. I mean, accountants are not, they get pretty good salaries coming out of college, but it's compared with where they can go. It's just not enough. And there's this sense of, well, you when you become a partner, it'll kick in then. You'll get paid off then. And it's like, first off, we know that you don't expect everybody to become a partner, right? We know that you're thinking it's a pyramid and a bunch of people are going to fall away and it's just going to be the top performers who become partners. So there's a little bit of disingenuousness there. But then there's also just the fact that I don't want to wait 30 years I don't want to get it when I retire. I can go to tech and get paid an enormous sum of money and buy a house on the beach now. Right. Why wouldn't I do that? And then, we talk about the extra, the extra year of college and the cost of that. I can go to an extra year of college and maybe get an MBA. And that credential, and don't get me wrong, I have an enormous respect for the CPA credential. But on the other hand, if I can get a credential that is, let's face it, pretty well respected, almost as well respected. MBAs, when you go into corporate, right? If they see an MBA and a CPA, they go, wow, those are both great credentials. They go, well, obviously the CPA is better. And the difference there is I don't have to take a big fat test to get the MBA, right? I can go the extra year of school. Okay, I paid the money, but I get the credential right away. And I think that's something to bear in mind. Again, I'm talking about sort of the broad profession has to think about how it's being compared to other credentials and how hard. Now, you would never want to see it dumbed down or made easier, but at the same time, you need to make sure that value is paying off. For people who want to take it or want to become a CPA, there's a lot of marketing work to be done and some compensation work to be done on the salary level start. So.
Oh, for sure. All right. So I think one important thing based on what we were just saying there is we've mentioned the 150 hours a couple times and that this is an issue that seems to be coming up more, I think partly because we are having this, 2% of college graduates are now 1%. We are having people not staying around. And so there's been discussions, and I've seen other states start talking about this. Do we want to reduce this down to a 4-year degree now? I think Minnesota is the first one to at least talk about this. Is there a proposal out there? What are they? And I think you wrote something on this recently.
Yeah, we just covered this, and it's fascinating. It's obvious people are naturally going to look to the 150-hour rule. It's the big change, right, that we can point to. We still have an exam that's been the same. The 150-hour rule is the big thing that's changed in the last 25 years internally to accounting, right? And so it's natural to look there and say that's the culprit. We are seeing, Minnesota introduced a law, and it's important to understand the law they've introduced. Because it's not just let's get rid of the 150-hour rule. What it is it's created 2 alternative pathways to becoming a CPA, or 3, if you want to put it that way. 3 is the traditional one. If you can go and get 150 hours and then pass the CPA exam and get the work experience, you can become a CPA. But they've added 2 alternatives that don't require 150 hours of college education. You get 4 years, and then I think it's 2 years of work experience. So instead of an extra year of college and then some work experience, you get double the work experience. So the notion is that live experience out in the market, out working with accounting firms, they're treating that as the equivalent of the 5th year of school. And then there's a second one that involves, I want to say it's 1 year of work experience and then something like 120 CPE credit hours in a short period of time, relatively short period of time. So essentially, you're taking that CPE credit again as a replacement or as a placeholder proxy for the 30 extra hours of education. So it's not really getting rid of 150 hour. It's finding alternative ways to get experience in education and so on. And I thought that was a really interesting approach to it. To say, listen, we're not getting rid of it. You can still do it that way if you want. Because getting work experience or taking a lot of CPE these are not, it's not easy. So I thought it was an interesting approach to it. There are some reasonable questions with it, right? Does it create problems with mobility? Is one. Those could go away if NASBA and the AICPA decided they should go away, but that's a little. But I mean, they could go. But there's a good question of saying, do we want to lower the bar for entry? Do you want to say, well, you used to have 5 years of school, now you only have to have 4? There's some legitimate marketing and reputational concerns there.
Yes.
It's just like saying, you wouldn't want doctors or lawyers to say, well, we've cut out a year of schooling for them. They're fine. They don't need that. You don't want that. You don't want that perception. On the other hand, I thought it was interesting just that people are experimenting. And I think that's a level of seriousness of approach to the problem that needs to be taken, right? You need to say, we really may need to shake things up seriously. Up to and including really looking at the core requirements for this profession to make sure that it can live on. So that's the one thing about that I would say is, I'm not sure that the 150 hours is the culprit, but I think that being willing to look at everything and say, what really do we need to do or what can we do that will seriously tackle this problem because it's so huge.
Yep. And I think I like what you said, that people are looking at. And it's kind of going back to what we said at the very beginning. There are a lot of changes. There are a lot of good changes that have happened. People are looking at changes. So we're being innovative. At least somebody's coming up with ideas. And honestly, if you go back to your medical profession analogy a little bit, I mean, part of the medical profession is, and I'm not a doctor, but I think they're out actually kind of working before they actually finish their degree. They're out hands-on doing stuff, which is kind of equating to this. Now I learned more in my first year in public accounting than I did in my 4 years or whatever mine was probably about 6 years, but
you could have gotten your 150-hour credits. That's 180 credits at that point.
Well, so I actually probably do have 150 because I got an undergrad degree in computer science, decided a couple years later I should have been a CPA, went back to grad school, probably have the 150. So, gotcha. But I actually don't have a degree. I don't have an accounting degree. I just had enough hours to take the exam, and so we did that. But yeah, I learned on the job.
You hear that a lot, right? You hear that most of what people learn in college isn't that useful. And that in a lot of states, those extra 30 hours don't have to have anything to do with accounting. And so like,
exactly.
Well, if they had something to do with accounting, then I might consider them more valuable and be less. But let's hope the clients don't understand that 5th year that's so valuable, that makes the reputation of the client, that they don't realize that it's not, it has nothing to do with accounting. It's basket weaving in French.
Right. It was the universities, the colleges, they didn't buy in on this 150, so they didn't put a curriculum in place for the 150 is what I understand. And because of that, it's just you got to get your 150 hours. And there is probably some additional emphasis on accounting and law and everything else. But yeah, it's out there. All right. So there was one other thing, or at least one other thing. Like I said, I could keep doing this we got 23 more hours to go. So on the marathon podcast interview here, you mentioned it about, nobody wants to wait till 30 years in before they get their money from becoming a partner and everything. Well, private equity, part of probably what they recognize is, we can come in and we can give this money out faster. And now we can also capitalize these firms and they can get more involved in technology and find out better ways to be efficient. Do you have an opinion or pro or con, or just what's your observation of what private equity is doing in the profession?
It's solving some problems, right? Some obvious problems, which are lack of capital for a bunch of different things. One of which, for M&A, for technology investments, for service line investments, and here particularly, and for people investments. And that's the thing you should say. You're able to pull some of those incentives forward because being a partner is an incentive if you plan to stay at a firm for your career.
Right.
And a lot of people these days, that is not as attractive an idea for them, particularly when they look at what partners do. Most of what partners do is talk about how much work they do. I'm kidding. I'm kidding. I'm giving
Oh,
partners
it's
a hard
not
time,
uncommon.
but it's true. There's a lot of
Yes.
complaining that makes it less attractive. Also, this always never fails to terrify me is the Mark Rosenberg talks about. He talks to young accountants on a regular basis, and he routinely say to them, how much do your partners make? And they routinely underestimate it by hundreds of thousands of dollars.
Yes.
And so they don't realize how attractive it is. I mean, forget the fact that it's 40 years away. They have no idea how attractive the money is.
Right.
So you got a couple of problems there. One, that it's too far away, and two, that they have no idea how big it is. And so, private equity solves some of that by being able to, to give stakes or bonuses or payoffs to younger hot talent that you want to keep. So that in that sense, it solves a bunch of problems. On another sense, I think it brings a whole lot of questions and unknowns. Basically, what do these PE people want? Who knows what they want? I have no idea. They want to sell in 5 years or 5 to 7 years or whatever their time horizon is. It varies from firm to firm, obviously, but or depending on how patient their capital is. But they, what do they want? What do they see in accounting? Are they seeing tremendous opportunity to turbocharge firms and boost their growth enormously and then reap the rewards of that? Or are they looking at like a steady, because accounting firms are pretty reliable earners, right? Even during the midst of the pandemic, they still grew 3 to 4%. And last year they grew, we just got these numbers in, they grew like 18%. It was a huge growth. So accounting firms are pretty reliable earners, putting up a pretty reliable stream of cash. Is that what they see in it? Who knows? I don't know. I'm sure, again, it probably varies from firm to firm, but you need to know that before you look to PE. And then you also, what's their time horizon and who are they going to sell to? Because once they own it, they could sell it to anybody. They could sell it to, me. They could sell it to the mob. Think about that. That's the next John Grisham novel, is a mob-owned accounting firm. It's who knows what they're doing. And I'm not suggesting there's anything shady or nefarious, but it opens up this whole, I would like it to be exciting if it were, but it opens up this whole can of worms of, where are you going to go and how far away from being an accounting firm do you end up? And so I think, I can't recommend it or not recommend it. I was on a call with a bunch of people talking about this recently. And one of the things we had to sort of keep reminding yourself was that PE firms vary as widely as accounting firms do. There are great accounting firms. There are terrible accounting firms. There's run-of-the-mill accounting firms. And the same thing for PE, right? There's going to be very good private equity firms that are genuinely interested in creating value and adding value and building a better business than the one they saw before. And then there's going to be asset strippers. I'm not sure how you get asset strip an accounting firm, but
right.
Actually, I take that back. I could totally see how you would do that. You would break it up and you would sell off the staff, as much as you're legally allowed to. But there's going to be differences in all those. And so the question is, it's the individual PE firm that you're dealing with will determine whether it makes sense and what their plans are, and what your partner goals are.
Yeah, and one of the things I think that I see, and you and I were talking before we started recording, we've both learned a lot of our private equity knowledge from Alan Colton.
Yep.
And so based on what Alan's told us, but the couple things. One, at least I want to assume that this is part of it, just allow them a bigger investment in technology, because technology is huge. Technology can make you more efficient. I'm assuming PE wants to take advantage of those efficiencies, but then also being able to increase your service offerings too, rather than just tax and accounting and auditing. Now we've got HR departments, we have IT departments, we have, investment groups that, we're offering investment services. There's probably a bunch of services that I never thought about before that they can probably bring in.
Yep.
Does that now dilute, or should we not be called an accounting firm then anymore? Or is this now we are a advisory? I guess a lot of firms are rebranding as advisory firms. So what do you think that PE is going to turn into from that standpoint?
Well, that's right. I mean, this is right. The fascinating part is the whole fact that you're seeing all these firms that go into PE that have to split themselves up into two different organizations. We're talking about it's the LLC and the LLP, but really it's right. It's the advisory firm and it's the old test firm, whatever the realm. Now they still operate effectively. It's not like they leave we got to build a wall down the middle of the office kind of thing. But I think that more and more that will become a very different. Right now, it's all the same term, and they kind of operate, but it's all in the back end where they, one firm leases employees from the others and stuff like that, and you don't really see it. And that may well be true, but I wouldn't be surprised if, as we go forward, that becomes more true, that you do see it, that you see differences. And I go back to this I keep going back to Andersen Consulting, and Andersen Consulting long before the collapse of Andersen, leaving Andersen because there was the big gap between a test and the high turbocharged consulting firm. And you don't need to go back that far. I always do because that's because that was one of the big stories when I
Accenture,
first started
right?
covering.
Wasn't
Yeah,
yeah.
it left and became Accenture, and it left some and people get confused. They think, oh, it left after Sarbanes-Oxley or something like that. No, it was 5-6 years before. But you don't even need to go that far back. You can go to 3 months ago when Ernst & Young said it's doing the same thing. It's splitting up its attest function from pretty much everything else, because pretty much everything else is making a lot more money or is a lot higher path of growth. And those partners don't want to be tied down to an attest. I'm putting words in their mouth, and they may disagree with. They would certainly say that is not what's happening at all. It's a carefully thought through strategy to deal with the modern environment, and it is. I'm wildly over exaggerating, but I would suspect that will play out much more over the course of, and again, it would depend on the PE firm. If the PE firm is there to turbocharge growth, as you say, take advantage of a bunch of efficiencies with technology, and then turbocharge the advisory services because there is a tremendous potential for growth there. If they're looking to do that, you will eventually find that there's going to be a growing gap between the LLP and the LLC, between the attest function, which is not stuck, but is remains doing this critical work of the CPA profession, and then the other part, which can grow as much as it can, right? It has no conflicts of interest. It has no,
right.
But has far fewer conflicts of interest. Now, the balancing part of this, and this is where things get complicated, and this is one of the reasons why it's fascinating to cover accounting. This is one of the balancing things there is, I think that the ESG opportunity is going to turn the turbocharged part of accounting to a test. I think we're going to find that over the next 3 to 5 to 10 years, the opportunity for offering a test services on ESG is going to make a test the hotbed of activity. There's just going to be enormous opportunity, and there's not going to be enough people. Well, there's already not enough people to do it, but there's not going to be enough firms offering that kind of stuff, and more firms are going to be able to do it. It's no longer going to be. I think it will be less the purview of just the big four and the large firms, but because right now, how many firms really do audits? Right, vast majority of audits are done by the largest firms.
Right.
I think we're going to find that there's an enormous explosion of opportunity in audit because of ESG. So that may balance that out. But if it doesn't, then, as I said, you're going to stuck with the profession getting further and further apart. The two big elements of it. One is the sort of core thing of this, and you mentioned we're not just talking about CPAs, but in this case we are. I'm talking specifically just about CPAs because the only thing they have a license to do, right, is the audit.
Right.
So if they sort of get stuck there, and they're going to see all these other things get hived off and say, well, we could grow faster if we weren't tied to you.
Right.
I think it's going to be interesting. It'll be fascinating to see how it plays out. It will play out differently at every firm. But
that's the one thing I say when, again, going back to that modern firm, the modern firm doesn't seem to be concentrated on the audits very much. It's all the other services, and that might be the case. You know what? Real quick, because I'm not sure everybody's familiar with ESG, and I know you did a whole series of articles on ESG. You want to give us a quick definition of what that is and why this is important to the accounting industry or profession?
Sure. Sorry, I should have explained it as I was saying it. So it's environmental, social, and governance reporting, and it's people talking about reporting on climate change things. So companies reporting on their carbon footprint, or on the amount of pollution they put out, or on where they source fresh water for their products, if they use water in their products, or where they source the materials and metals that they use in their products, all that sort of stuff. That's part of it. There will eventually be some social reporting around diversity, for instance, or your impact on the community around you, or your engagement with the community around you. And then the governance is sort of how you're structured to operate responsibly in a modern environment. Those are all three at different levels of reporting. But for instance, the big issue right now with the E part of ESG is the SEC recently put out a bunch of proposals on reporting around climate change. And that's still in the proposal stage. People are still looking and commenting on it. They're going to, undoubtedly, they are going to require some reporting around climate impacts fairly soon. There already are, and to be clear, there already are some responsibilities for that, but there's going to be a lot more, and they're going to be a lot more standardized. There was something like, I'm estimating this, somewhere between 700,000 and 800,000 different frameworks for reporting all kinds of environmental stuff. And those have all consolidated down onto the point where there's very few of them, which means that there's some consistency around the world, right? There's now the International Sustainability Standards Board, based in, I think, Montreal and somewhere in Europe, run by the IFRS Foundation. So there's going to start to be standards put out that are reliable, that people can use, that have some comparability across the world. And governments more and more are going to be requiring this kind of reporting. Stakeholders are going to be requiring this reporting. Markets are going to require the reporting. We've already seen that investors do it when they want to do sort of socially responsible or environmentally responsible investing. But the point is that more and more companies are going to be required to report on this kind of information. And it's going to look just like, you have to go back to the 30s to really get a sense of what this will look like, because you have to go back to the 30s to say, well, what did it look like when all these companies suddenly had to start reporting their financials to the SEC or whatever markets they were involved in? And they didn't have any of these structures in place, or they had structures, but everyone's structure was whatever they wanted it to be, or whatever their bank required it to be, or whatever their, whatever Mr. Rockefeller required, or Mr. Carnegie, or JP Morgan. So think about that, what that would have looked like, helping all those companies get ready to put out a modern financial statement. Imagine what that's going to be like. And that's what it's going to be like for ESG reporting, because there's no models for this, or so many models that effectively there isn't one, because they're all over the place. They're going to need help setting those systems up. Every company in the world is going to need this.
Wow.
And then they're also going to need attestation around it, right? That every year someone's going to have to go in and say, yes, this is your carbon footprint. You are measuring your carbon footprint correctly by the right standards that everyone agrees on, and you're going to pay us for it,
right,
just like you do for a financial statement audit. So that's just when you think about all the different things you can report under ESG. That's, every one of those is the equivalent of another financial statement audit. Now,
right,
there'll be, I'm exaggerating slightly for effect, because there will be a lot of overlap. Some of these things will be reported through the financial statements, and a lot of them will involve similar types of information. But it is a huge opportunity. And it doesn't require, I know there's a lot of people in accounting, because we hear from them, but a lot of people in the country as a whole who disagree with the premises behind requiring this reporting, and that's fine. But the reporting is going to be required.
Yep.
Whether people disagree with it or not, there are states that are trying to ban it, for instance, or ban certain elements of it, or make it not a requirement, that kind of thing. And that's fine. The political aspect of it is a whole other question. But the fact is that this reporting is going to be required. Firms are going to have to have it attested to. This is a tremendous opportunity for accountants, assuming it goes on where in the model, in the sort of with the momentum it currently has.
Right.
And my suspicion is that it will. And even if you don't like it, people are going to have to do it. They're going to be turning to accountants for help with it, and it's going to be a great opportunity.
So auditing is not dead then. Auditing will survive.
Hi, that's my suspicion, and this may be its savior, right? Is that there's always going to be auditing. The question is, can you build a successful firm around it? And this goes back to our question about, do we need accounting firms? If accounting firms can't make the revenues they need, if they can't pay the bills with just audit work, but they're getting split up because the PE ownership rules require them, right? Or I should say the CPA firm ownership rules require the audit firm to be independent. They're going to need a savior. They're going to need something to help them out. They're going to need a different model for, and if that model is we do 90%, ESG attest work and then 10% financial statement work, there you go.
Yeah. All right. I think that was a perfect circle there. We just went right back to the beginning, wrapped it up. And so the answer is yes, we do need accounting firms.
Thank God. Whew. Otherwise, what would I cover?
So we did this full circle now, and there's one last question, and I didn't warn you ahead of time. I probably should have warned you ahead of time, but there's one question that I ask everybody at the end of each podcast is, all right, so we just talked about the profession for 45 minutes. We determined, whether you agree or not, that you're the voice of the profession, and
God help the profession.
When you're not out being the voice of my words, not yours, you're not calling yourself this. When you're not out doing this work you currently do, what's your passions outside of work? What do you do for fun? What do you like doing when you're not out doing accounting today stuff?
Sure. So probably my biggest thing is I'm on a trivia team in New York. I love trivia. So I'm out there on a regular basis. I spend a lot of time reading just because I like reading, but also a lot of time reading, trying to learn stuff so that I don't lose at trivia next Wednesday, which really started as, I should say, really, I'm passionate about drinking in the middle of the week because it's all at bars. But it turned into a love of trivia that, I'm on a team here in New York. We've come very close. We came close. We were second in the city once.
Wow.
But then, as I said, we drink too much in the middle of the week. But so that's a lot of fun. That's good. I enjoy doing that. And I would say that's probably my big passion.
That's awesome. I like that. So what's your drink of choice then?
At the bar, we go to the same bar every week, except this week, I should say, the week we're recording, we're not going to be there because they're filming an episode of Blue Bloods there, which gives you a sense of what kind of bar this is. It's a beautiful old, it's not an Irish bar, but it looks like it should be an Irish bar. Yeah. Yep. Beautiful wooden bar and old fittings and all that sort of stuff. They're filming an episode of the Tom Selleck cop show, Blue Bloods there. So we're not going this week. But my choice there is Narragansett Lager beer, which is a classic American lager out of Rhode Island. For anybody who's listening from Rhode Island, it is also, and this is the trivia angle. That's how I'm bringing in the trivia.
Nice.
It is the beer. If you remember the scene in Jaws, Quint, the fisherman, Robert Shaw, Quint, drinks Narragansett throughout the movie. And it's the beer when he crushes the beer can, famous scene where he crushes the beer can, and then Richard Dreyfuss crushes the styrofoam cup. The beer he's crushing is a Narragansett lager beer from Rhode Island.
I've heard of Narragansett. I don't think I've ever had it. I've drank pretty much every beer around the country. That's one I've missed. So I'm going to have to seek that out.
It's now getting available. You now get it available across a big part of the country. I'm surprised at the places it shows up. It is not a craft beer. It's a classic American drinkable lager, like a Schaefer or a Schlitz or something like that. But it's pretty tasty, and it's I recommend it. It is a good hot summer day beer.
I assume it's an independent brewery at this point, but I don't know. Maybe they were bought out.
My understanding is that they're still independent.
Yep.
I double checked it. I have to go to Switzerland and see where the ownership is registered. It probably belongs to InBev or AmBev or whatever the South African or Brazilian based company that owns every brewer in the world is now. But
yeah, or Duvel or Heineken or whoever. Yeah.
Sorry, now I'm thinking about. I lived in Brussels for a year and a half, and so got used to a lot of the delicious Belgian beers. That's
there's some good beers out there. All right, so I can talk beer for another hour. So we're going to stop there. I just again want to thank you for being part of this. I appreciate the time. I just want to again before we finish up here, promote the fact that, and this is not a commercial for this, but I just looking forward to this conference. You are going to have your conference in San Diego, May 8th through the 10th. I got those dates right?
That is correct. The Firm Growth Forum.
And so how are you going? I assume there's still room for registrations at this time?
There is still room. We still have some spaces. We hope to get a good crowd of folks. We're not looking to make it a huge conference. We're not looking to have thousands and thousands of people wandering by. Because one of the things we found is accountants learn best from each other, right? So we want to give everybody a chance to, a small enough group could be a little intimate. People can talk amongst themselves, share their own stories, but also has the sort of the weight of expertise there that they're really going to learn something useful. So yeah, we're excited about it, looking forward to it.
Yeah, and that's the one thing I really love about the conferences like this is that I think you learn as much after the presentation, just talking with everybody else you're there with, grabbing a Narragansett or some other beer and having a good time and learning and just getting to meet other really fascinating people in the profession.
Yeah, excellent.
Thank you for joining us today on the Unique CPA. You can find all the links and show notes for today's episode, as well as more about TriMerit, at theuniquecpa.com. Remember to subscribe and join us for our next episode where we'll be going beyond compliance into forging new pathways of delivering value to your clients, diversifying your revenue streams, and leading-edge management techniques and styles.